But tonight I am hosting with a very special guest. We have a guest speaker today. But a little bit about myself. My name is Marlena Smith. I am a proud partner to all these lovely people here at Our Infinite Company. And I have been licensed for about 7 years, but was introduced to this industry as a client. So when I had my first child, he was born December 2013. In January of 2014, I was blessed with family members who came to visit and brought me the best gift ever, which was this $1 million baby plan for my son. So in that moment of chaos and stress of being a new mom, I was blessed with something that gave me some peace of mind and certainty. So this is very near and dear to my heart. Definitely something that really connected me with this industry and what I'd love to share. But tonight we are going to hear from Mr. Hans Augustin, who is going to start this call off for us. And he is an exceptional person. I'm so honored to be in business with him. Everything he talks about is full of passion, and you definitely want to listen, be ready, take notes. So I'm going to go ahead and pass the mic to Mr. Hans Augustin from the East Coast, who is with us at 9:34 p.m. tonight. So give him your attention and focus, and let's honor his time. Thank you.
Hey, good evening, everyone. I hope everybody is doing well. Thank you, Miss Marlena, and all of those that are part of this platform of serving students and kind of making sure that your child has a very clear understanding of what's important. Uh, if you've never met me before, as Miss has said, my name is Hans Augustin. I do live in the state of New Jersey, and maybe some of you guys are here from the West Coast or all around the United States. But I'm excited about being able to share information about with you guys on how to leverage what we call a $1 million baby plan. And as I kind of go through the slides tonight, I'm going to kind of make sure that you walk away with, along with my business partner, Miss Smith, with information that I believe is actually going to shift. And before we go to the next slide, I really wanted to kind of make sure that as I've been sharing with many as we talk about financial education, one of the first places that you start with is within your home. And I'm proud to say that a majority of all my children, except for one last one that we're working on at this moment to kind of make sure that they have their $1 million baby plan is all installed. And I'm excited to see what kind of businesses and houses and things that they're going to be able to develop. So I'm going to ask Miss Smith to kind of man the slides for me tonight as we kind of navigate. But one of the reasons why we've been talking about financial literacy or financial information is because there's a reality happening in America that I'm trying to help avoid for my children. The first time I started teaching my son about money was early 15s at the age of 15. And one of the reasons why is because more than 60 to 70% of Americans today are pretty much living paycheck to paycheck. I could personally remember those days of kind of just being in a position where the next check actually mattered. And what we're going to do tonight is share some information that says, hey, if you begin to understand that more than 47% of people cannot actually afford $1,000 worth of emergency money, and when I sit down with folks, one of the things that we talk about is a financial foundation. And part of that financial foundation, outside of the fact that they might need some protection, one of the columns says that you need emergency money because there's these things that pop up in life that unfortunately was not part of the budget. And if the average American only has $1,000 in their savings account, it can be very challenging. But the biggest concern is if you reverse the numbers, is that if there's only $1,000 in savings account, but the average American actually is carrying more than six figures in actual debt. That means that when they did the numbers, they quickly identified that people carry an average of $104,000, even if it's not in credit card, it could be student loans, it could be a personal loan, but essentially, but if you're trying to send your children to college, and which is what most Americans want to do, is that they end up owing about more than $37,000 worth of federal student loan debt. I personally can witness to the idea that when I went to college and decided to do it, it was based on student loans. And it took me a little bit of time to really navigate the idea that if you understand what a student loan is or a credit card debt, it's actually the reverse of what you're going to be able to do in this particular plan, which is the law of compounding interest. But here's some more facts. The average monthly Social Security benefit in 2025 was about 1,900. That means that after your parents or myself or anybody else who gets to that age of retirement, they're basically saying that they're living their lifestyle. So if your lifestyle costs you 60, 70, or $100,000 to live, then what really happens when your potential bottom line is about 2 grand per month, which really equivalents about $23,000 per month? The average 403b, if you're not familiar with a 403b and this is your first time on the plan as a parent, a 403b is essentially the same thing as your 401k if you work somewhere corporately, except for that it's available in schools or nonprofit. But really, the average 60-year-old has only been able to save 240,000. What if they could take the $104,000 and add it to that pot? But this is the current financial reality for most. One more point of information. It says the average person will change careers for every 4 years. And essentially, it's basically positioning them very differently. And when you begin to understand how this works, this is why tonight, by the time my business partner, Ms. Smith, begins to share some more information tonight, you'll begin to understand some of the facts. And you begin to understand a way to actually solve that for many of your young children. I'm going to ask my business partner to share the next slide. It says, what actually is a $1 million plan? I'm going to actually share a quick 2-minute video. And the other thing before we share this video, if you do have a paper and pen, you want to take some notes or take photo of the slides, please do. But I'm going to ask my business partner to go ahead and hit click so that we can give you a little overview before we continue with some information tonight.
Yes, so sorry, I'll play it. Just 1 second. I just realized I didn't connect my sound. So give me 10 seconds, guys.
No problem. But as we share this information tonight, you guys will realize that essentially this is a way that we can help your children as young as a certain age begin to develop and grow money. And this actual video is going to give you a nice cue of how this information works. And then we're going to continue to share some solid information that's actually going to continue to help you guys understand how you can develop this $1 million plan for your family.
A pretty money-savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Index Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
Thank you, Ms. Smith. And as you guys understand the video, one of the things that attracted me the most when I was learning to understand the idea of wealth was really starting early for our children and beginning to understand that, hey, what if you are able to teach your children how to produce $1 million, right? So what that means is it's not really about the money, it's really about the idea of the resources that you can position your kids to actually have access to. But let me give you some more details. As you guys heard in the video, an index universal life is actually an account that we can establish through an insurance plan. And one of the ways that we've learned to level this is actually helping your children build what we call generational wealth. So when I helped structure this plan for my son, who was about 18 when we actually established the account, the whole idea behind it was to position him for the future. If you guys noticed in the video, it said that, hey, maybe by the time that child that was organized under this particular account is going to be positioned to actually have access to $1 million worth of funding. But if you notice, it said it actually can convert into an income. One of the reasons why I find this to be very intriguing is because in what I do, everybody, if you've never met me before, is that I sit down with teachers and staff members and school districts to understand how they can retire better. And one of the unique things that you guys will begin to understand is that if you could position your children today, you're not really talking about retirement, but you're literally telling them, hey, here's a pool of funds that I can help put you together. And what happens is that we can literally teach you guys through the process of what I call accumulation. Meaning that what's interesting about young children is that they have so much time. If you had the ability to write that down, young children actually have the ability to have so much more time. And what we're going to do is we're going to position them over the long term. So this is a goal that we're going to help you guys create, which is we're going to help position your children to have financial benefits that actually include a tax advantage position. Meaning that I don't know how many of you guys don't like paying tax, but I'm one of them. Meaning that if I could teach my Jalen, if I could teach my Justin or my children or my granddaughter Brooklyn, these are really important to me because they're part of my legacy. And what I'm doing is positioning them to have access to money and show them how to leverage the money. Leverage means that if you notice in the bottom slide where it says goals, it says creating a lifelong financial benefit, including a tax advantage and a death benefit. So an index universal life is first an insurance policy. Number two, it's a way for you to accumulate money in that account. And then now, one of the benefits outside of the insurance, which is tax free, or the money that you're growing, there's also something called a living benefit that's tied to it that we won't go too deep. But I want you to teach your children how to borrow against the value. So here's how it works. If you purchase an IUL policy early, either you as a parent, or if you're a grandparent tonight, or if you're a legal guardian, we can show you how to open up these IUL policies for your children. And what we do is we use the word premium or contribution where you can actually pay it into this policy where we can grow the value of your dollars, but they just call it cash value. But one of the reasons why this is important is we can show you how to tie this cash value to what they call an S&P 500, which is just another way for you to grow your money. But there's one beauty behind how this money grows, meaning that there's value that we can add interest rise based on the amount of money that this interest strategy can put in place, but you're never going to lose any value because of how we position. So what happens is an index interest strategy is actually tied to a way that you can grow your money. So now here's the options that you have when you're growing money. Meaning that if you walked into any place and they say, hey, Hans, or hey, Miss Smith, here's how we grow money. We actually can grow money in a fixed environment, which means that we can pretty much give you some guarantees, but we can give you some interest, but the growth of it is going to potentially be, conservative. Or, hey, let me show you what a variable account is. And a variable account is just positioned to say, hey, listen, I'm going to help you gain a potential lot of interest, but there's a rule that you got to know about variable accounts. It basically means that, hey, you could lose value over time. But what we do, since we want to leverage the growth for your children, is we use indexing. Indexing is a way for us to help you open an account that guarantees a bit of the contributions that you put along the way. Those are protected, but we're going to grow that account in value so that when your children need it the most, And so I just share these options so you can understand how we leverage the money in these accounts. And then I'm going to share the next slide so that we can kind of give you one more piece of information. I want to, before I pass it over to my business partner, Ms. Smith, the key component for your children is this cash value growth, which means that what if I can help you establish an account for your children that would position them to A, help them establish a business, potentially grow, go to college, or establish themselves a down payment on a house. But the reason why we did it is we can help you grow the value of your dollars in these accounts. Basically, it says cash value grows. One more step back. It says cash value grows in a tax deferred, meaning you don't pay taxes on the growth as it occurs, and your child at a later time. That's when the down payment comes in. That's when the ability for potentially them to access for college or the ability to actually retire in the future. So I'm going to pass the rest of the presentation to my business partner, Ms. Smith, as she kind of continues to share some of the additional information that will help you make a better decision on how to establish this type of account.
Amazing. Thank you so much, Hans, for all of that valuable information. Really, like I said, this is a very special plan to me. And besides that cash value growth, it is that wealth transfer and legacy, right? So the child can continue funding the policy into adulthood, which allows them to grow it into this $1 million asset. I'm going to show you guys later on an illustration what that could look like potentially for your child. But upon their passing, they can keep this plan for a lifetime, right? So upon their passing, their beneficiaries will then receive a tax-free death benefit. So that means you're not only protecting your child when you put a plan like this in place, you are helping build your legacy for generations to come, right? Because this money will go to your grandkids, to your great grandkids, and they're going to pass this knowledge down as well so they can continue having plans like this and truly change your family name and how you guys are building wealth and creating a legacy. So as we are talking about this, right, this is uh, it is tied into a life insurance, but this is also a part of your financial foundation. So when it comes to building wealth, we need to first look at when we sit with our clients, we look at these four pillars of their building blocks and how strong are they, right? So the first one is growth. We want to see, do you have a good rate of return on your short and long-term investments? How is your money growing, right? We invest money because we want it to grow. Number two is safety, right? Is your capital safe from what's going on in the market right now, right? If the market drops, are you afraid that you're going to lose a big chunk of your retirement, or do you have that safety, that guarantee that your capital is safe no matter what? Number three is tax advantages. So do you know how taxes really impact your financial household? And understanding taxes will really help you build that wealth, right? So we use this analogy of the farmer, right? A farmer has to pay taxes at some point, right? He gets $100 worth of seeds. He plants those seeds, grows them, harvests, sells everything, has $100,000 in profit. But he still needs to pay taxes. So we say, knock, 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 Mr. Farmer. You still need to pay taxes, but you have the option. Do you want to pay on your $100 seeds, or would you like to pay on your $100,000 profit? Which would you choose, Mr. Augustin?
Uh, Choose the best plan that you choose, because you are my business partner. I follow your lead.
Perfect. So we're going to pick the seeds, right? We want to pay taxes on the seeds, not the harvest. So understanding that, understanding taxes and how that can work for you. And then protection. So protection is the last one on here, but in our opinion, the most important, right? This is the most important because you're not just protecting your life, right? You're not just protecting your life, but you're protecting your ability to generate income for you and your family, right? So if something happens to you, what happens to your family's economy, right? Will your children, will your wife, your husband be able to stay in the home that you guys are in, right? So you want to protect that ability for you to generate income in case something happens. Uh, and we would say, what if something happened to you, but you didn't die? Right? When I first heard that question, it really made me think, right? Because we think about if we die, I have life insurance, something's left for my kids. If you're healthy, you can work. But what if something happened to you and you didn't die and you cannot work, but you still must continue to live and take care of your children? What do you have in place, right? So protection is definitely very important. And if we look on the building block side, it is actually the foundation of a strong financial household, right? But what is the foundation in your opinion here? You guys can either unmute or put in the chat. What is the foundation of most financial households? What would be their biggest financial number? What do you think?
Are you saying
Any
from,
guess?
I think would say at least from a protection standpoint, is that the question that you're asking, or you're saying, or do I
Protection
believe?
should be the foundation, right? But what is usually the foundation if we're thinking about how people's household financial households are, right? I'll continue just so we can go through the slides, but most people's foundation is debt,
Yep, you're
right? It's
correct.
debt. Their house alone is a few hundred thousand. They have credit card debt, they have student loans, maybe some medical bills, right? But ideally, it should be protection so it can help you with those things in your time of need. Next, we want to look at debt management, right? We want to make sure that you're taking control over your debt and not letting the debt control you. So one form of uncontrolled debt that we talk about is credit card debt, because if you are just paying the minimum on your credit card, we teach our clients in our community about the rule of 72. And the rule of 72 is a simple mathematic concept that just takes number 72 divided by your interest rate. And that's how quickly, and that number you get will be how quickly your money will double, like how many years it'll take your money to double. So if we take $10,000 and you put it in a 1% savings account at the bank, based on the rule of 72, 72 divided by 1 is 72 years before that $10,000 turns into $20,000, right? So understanding how your money grows, of course, very important, but the same goes for debt. That formula can be used for debt also. So if an average credit card is 24%, 72 divided by 24 is 3. That means if you are paying the minimum on a $10,000 credit card, that $10,000 will be $20,000 in 3 years. It'll be $40,000 in 6 years. It'll be $80,000 in 9 years. So it's important to take control of that debt. I think of that as uncontrolled debt, right? The end is nowhere in sight. So we want to make sure you're taking control of your debt, understanding what you have, paying that down. And of course, next is an emergency fund. So Hans talked about this a little bit. You want to make sure that you are prepared for an emergency, right? The statistics said 47% of people cannot afford a $1,000 emergency, right? And somebody told me, one of my mentors once told me, it's only an emergency if you don't have the money, right? So if I have to get 4 new tires and I have $100 in my bank account, it's an emergency, right? I don't know how I'm going to get to work. I don't know how my kids are going to get to school. We need to plan a few extra hours to take a bus or whatever. Or if I have that money, it becomes now from an emergency to an inconvenience, right? So having an emergency fund is very important. We learned that during COVID. 3 to 6 months is what it says here. We recommend 12 months if you are able to build up to that, right? And then you want to look into investments, 401ks, 403bs, things like that. Once these blocks are stable. Excuse me. So to summarize this $1 million baby plan, if you guys are not excited and ready to get it already, I'm going to summarize it really quick. Has tax advantage growth, so that cash value grows without immediate taxation. It's flexible access of your funds, right? Your liquidity to your money. So loans can be taken tax-free for major life expenses. You have market protection, the power of zero, right? Where your money is safe. but you are still able to benefit from the gains in the market. And then legacy and death benefit, right? Provides financial security for future generations and helps you build your legacy. So an amazing plan. I have it for all of my children. And don't feel bad if you don't have any children because you can be $1 million baby too, right? I am $1 million baby, and so are a few of my business partners on here as well. So this plan, it is not too late if you are interested in starting something like this for yourself as well. Okay. But if you already have something in place for your child and you want to know maybe how does this compare, right? This $1 million baby plan sounds great, but I'm already putting away some money. How does it compare to maybe you're putting something in a 529 plan or a brokerage account, right? So as you can see, just from looking, um, the $1 million baby checks all of the boxes here, right? But these are things you want to consider when you're saving money. Is it after tax contribution? Is there tax deferred growth? Is there tax-free distribution? What is the growth potential? What is the market risk, right? Is there tax-free liquidity? Can I access my money tax-free? What can I use it for? Are there insurance benefits and will it affect financial aid, right? If that's something that you are uh, looking into for your child, right? So if we look at here, a brokerage account does have tax after tax contribution and growth potential, but that's about where it stops, right? We look at a 529 plan. It's an amazing plan for saving for education. It does have that after tax contribution, tax deferred growth, tax free distribution, and the growth potential. But it is still at risk to how the market performs. There is not tax-free liquidity depending on what it's used for. It has to be used for education, right? So if your child does not go to college and you don't have another child that wants to go to college, then either you yourself will have to go to use those funds or you will have to pay penalties to access your money that you have been saving, right? There are no insurance benefits tied into it, and it does actually affect financial aid. So if your child does decide to go to college and you want to apply for financial aid, this 529 plan is going to show as an asset and they may be denied financial aid, right? The $1 million baby plan um, has all of these and more. So I'm going to go to the next slide here. And hopefully by this point, you are thinking, how do I set this up, right? It's not complicated. It's a very simple process. Number one, of course, you want to choose a reputable insurance company. So whoever invited you to this call, we will definitely take good care of you and make sure that we are selecting a provider that is suitable for your needs. And all of the companies that we've worked with are A or higher rated companies, and they have been around for over 100 years, some 177 years. So definitely great, reputable insurance companies are on our platform. And number two, you're going to select the policy holder and the insured. So as we touched on before, the policy holder, the owner of this policy is going to be either a parent, a grandparent, or a guardian, and the insured is going to be the child. And then when it comes to determining coverage and premiums, this is where we come in, right? We do what is called a financial needs analysis. We check what it looks like. We're not just going to give you a quote and not look to see if it's actually something that is suitable for your family, right? So we want to do a thorough financial needs analysis and really make sure that we are helping you determine the coverage of premium that works for your family's goals, needs, and objectives. And then once you decide on those premiums, higher early contributions allow for faster cash growth, right? So if you're able, we recommend putting more money in the beginning. And then if you want to lower or even stop payments at some point, then we can help you structure it in that way. So some people do what's called a limited pay structure. They'll pay for 10 or 20 years. Like if a grandparent gets this plan for their grandchild, they say, I only want to pay for 10 years. We can help you guys structure that so you have maximum long-term growth and it meets the goals of that grandparent for their grandbabies. And then you can customize policy features. We talked about the S&P 500, but there are also different index strategies available depending on which companies we are working with. There's a cap and a floor, so you get that upside potential with protection against any losses. It allows for future tax-free access of your funds through loans and withdrawals. And then there are also optional riders. So I'll talk about some of those a bit more when we go over the illustrations. Then we submit the application. We do the whole thing with you. We're not just going to send you a big old packet and say, please get this back to me, right? We go through the whole process with you and follow up until the policy is fully enforced. Once it is enforced, then you will fund and manage the policy. Make sure that you like the person that you are working with because we are going to be in your life for a long time. We will be doing annual or it maybe even reviews every 6 months with you just to make sure that you're still on track. It still aligns with what your family needs. And, life changes. A lot can happen in a year. So we just want to make sure that this is still a suitable plan for you and your family. So we have the scripture here, right? Train up a child in the way he should go, even when he is old, he will not depart from it. So we are not just creating these plans or starting these plans for our children. We want to make sure we are also educating them on those financial concepts that we've gone over so that they know how to do this for their families and can teach their children and so on. And it really carries on for generations, right? So the mission is big. So I'm going to show you guys some real illustrations. If you're a visual person like me, that sounded like a lot of great information, but you want to see how does this really work? How would this come together for my situation, right? And of course, you will get that information when you schedule your appointment with the person that invited you, but I can show you a few examples here, right? So this one is for one of my business partners. She started a plan for her son when he was 9. This is not his first plan, so you are not limited to just one. But she started this plan because um, life insurance has evolved, right? So when she first got a plan like this for her son, just like myself in 2014, when I first got a plan like this for my son, it had the life insurance, the cash value growth, but there were no living benefits available for children at that time. So it really has evolved. Now these living benefits, these amazing living benefits are available for our children. And so once I found out, we got more policies for our kids so they can have the living benefits also, right? And you'll see why that's important. So in this policy, they're going to put in $100 a month, right? $100 a month. Uh, Instead of putting it in a savings account or under the mattress or whatever, they're going to put it into an account like this, $1 million baby plan. If something, God forbid, were to happen to their son tomorrow, if he were to die too soon, there would be 186,386 available for the family, right? And we're not here to profit off of losing our children, right? But we also don't want to do GoFundMe accounts and pray and hope we can do a proper burial for our children if something happened, right? So just to be prepared. But what we hope happens is that he lives a long life, a long, healthy life, right? So if that happens, this is where that cash value growth comes in, that cash value accumulation. It says here, if King David needed some cash at age 69, he would have $1,956,365 tax-free available to him. So that is why we call this $1 million baby plan, right? So we're putting the numbers in for our own children. We have implemented this for our own children because we saw how powerful this was. And you can see here, if he doesn't touch it, he wants to let that money continue to grow and compound. By age 74, it'll be 2.7 million. By 79, 3.7. 84, 5 million, right? And like I said, this is not his only plan. So what if he doesn't even need to touch this and this $5 million is now going to his children, his grandchildren, your great grandchildren, right? So very important plan to have and amazing way to teach our children how to pass this on to the next generations. Okay. But the living benefits, okay? What if he were to become ill, right? That question that I asked. What if something happened but you didn't die? What is your plan, right? This is where these living benefits kick in. If King David were to have a terminal illness, this is projected at age 65, he could access $1.5 million of this to use how he would like. You know, I was introduced to this company and industry, like I said, through this $1 million baby plan, but I saw how these living benefits and why they were so important firsthand when my cousin Leonore, who introduced me to this business back then, was diagnosed with a terminal cancer at age 36, right? She was healthy, she ate organic. She worked out, did Zumba, all the things. Wanted to have a baby. Was going to the doctor. They thought she had fibroids. Removed them kind of carelessly and realized those fibroids were actually cancer that they just spread all through her abdomen and told her she had 6 months to live, right? Because she was in this industry, because her husband was in this industry, they put this plan in place for themselves, right? So I said, you can be $1 million baby also. So at 35, she took out one of these plans for herself because she knew she wanted to have children. So she didn't have to wait until a few years later when the kids were actually born. She was preparing ahead of time. Unfortunately, she was diagnosed with this cancer and was able, though, to access her money from this plan, right? We don't want to think about it happening, but when you understand in those moments where it's already so stressful, you're already, you know, hearing you're going to lose one of your loved ones and going through the illness, you don't have to now also add financial stress on top of that. And seeing how that really made a difference for her mom to be by her side 24/7 for 6 months, her husband, for them to stay in their home, for her to do the type of treatments that she wanted to do, right? She wanted to do some natural treatments. She went to Mexico and did something out there. She was able to do that, right? Because she had this plan in place. So these living benefits are very powerful. If you have a chronic illness or critical illness, there is money available up to $1 million lump sum or monthly if it's a chronic illness. And then Alzheimer's disease, which is on the rise, right? We're on screens so much now that it's rapidly increasing people that are diagnosed with Alzheimer's and dementia and things like that. So having this in place is also very helpful for your family, right? We have a business partner, right? Just like I said, my cousin prepared before she had children. She put a plan like this in place. But we have a business partner who is not married. He has no children. He doesn't own a home, but he has millions of dollars of coverage and plans like this specifically for those living benefits because he says, I know if something happened to me, my family is going to do all they can to make sure that I stay around. My family is going to come out of pocket to make sure I stay alive, right? So he's doing this to protect his family from having to do that because they love him, right? And they'll do it regardless, make it happen, right? But let's talk about the money part. They're putting in $100 a month. They're going to do that for 5 years, right? So $100 a month, 1,200 a year. Uh, After 5 years, they're going to up that a little bit and put 200 a month. They're going to double. And then once King David is an adult by age 19, they're going to teach him to match what they're contributing, right? So they're going to still continue to put 200 a month, but they're going to say, son, it's time for you to have this discipline to build this muscle. We want you to contribute 200 a month also, right? And they're going to do that until he is age 45. So again, you don't have to pay into this plan forever. We can structure it however works best for you and your family. But age 45, they're going to stop paying here and they would have contributed over a 37-year period, $147,600. But because it's index growth, they're not losing any money in the market and they're allowing their money to compound in here, plus the time because he is a young child. All of that has turned this 147,600 into $412,000, right? That's pretty good return on investment. So they've got all the money back that they've contributed into this plan. They still have a death benefit of $886,000 if something were to happen to him, plus all of the living benefits that were shown, right? So essentially, all of those benefits are now free, and you're just growing your money somewhere that continues to grow even if you are not contributing, right? So they stopped contributing at 45. At 49, it's grown to 533,000. By 60, it's hit that $1 million mark, right? $1 million baby by 60. By age 70, 2 million, as we saw in the other one. By age 80, almost 4 million, and he would be able to leave this to the next generation if he were not to access that cash, right? So very, very powerful plan. Again, it's available to not just babies. So in this one, we did it for a young adult. The same thing. If you were to die too soon, there's over 167,000 that'll go to his family. If he needs cash, this one is structured a little bit different, right? This one shows a lifetime income. So as we saw in the video, it said it can generate an income stream, right, of potentially 75,000, I think, in the video. So similar here, you can create your own pension-like income. So that's what I did for this young man, so he could see that living benefits all still available. Okay. So again, he's contributing into this plan. For him, we only do it for 35 years, right? And the reason for that was we were doing some comparisons to Social Security, and we learned that the highest payout you can get from Social Security is a little over 5,100 a month. But in order to get that, you need to work for 35 years. You need to make over $176,000 a year, and you cannot access the Social Security benefits until age 70, right? So I used some of those numbers to show him how this would compare, right? So he pays into this for 35 years, $181,200. Again, his 181 turned into almost 500,000 as we saw in King David's. So it still works just as amazing. If you're older, you may just have to contribute a little bit more. But by age 70, he decides, I'm going to start getting income. He stops working. He can get $78,948 per year tax free for the rest of his life because he put money here for 35 years as opposed to other options, right? But if we look here, this is where I think it's very powerful. These first 3 years of him getting income, he's already taken an income of 236,844. So he only put 181,000. In the first 3 years, he's already surpassed that in the lifetime income benefit that he has. Plus, he still has over $1 million in his cash value. And if he were to pass away, 1.18 million would go to his family. I'll take five, right? I'll take five of these. So this is information that we want to get out to the parents, but it definitely to the children as well, so that they can break these generational curses and no longer be those statistics that we saw in the beginning of this meeting, right? These plans will cover up until age 120. So if this young man is living a long, healthy life, which is very possible because he will not have financial stress bringing him down, right? That 181 that he put in, over $4 million he would have received as a lifetime income benefit from this plan and still have 88,687 left to leave for his family so they don't have to do GoFundMe's and things like that. So if you are still not convinced, I'm not sure, maybe we were on mute, but hopefully you got a lot of value from this call tonight. Your next steps here would be to get back to the person that invited you, set up an appointment to structure a plan like this for your child or even for yourself, and let us help you create $1 million babies. And again, we do this call weekly. So if you have anybody that came to mind while you're on this call, please refer them to this call so we can share this same valuable information or connect them directly to the person that invited you. But that is our call for tonight. Thank you guys so much for joining us this Wednesday evening. I do not see. Thank you so much, Miss Fola. Any questions? We have a couple minutes, but if not, we will let you guys go because I know it is late all around at this point. Does anybody have any questions or comments? Thank you so much for hosting with me tonight, Hans. It was amazing and a pleasure to do this call with you.
I will do it again, Miss Smith. Thank you for allowing me to serve.
Awesome. Thank you guys. All right, no questions. So contact whoever invited you, and we will see you next time. Have a good evening, everybody.
Good evening.
Okay.